Nothing gets me going like that intro, Jason. I had literally nothing to talk about going into this episode because we're pre-recording this. We've hit the summer travel schedule. You and I have to pre-record these. We can't be live every Friday, unfortunately. One of us, the one who doesn't have a newborn infant child at home, is going to be gallivanting around Europe for most of the summer. And so we got to pre-record these. And well, this one's being recorded on a Tuesday afternoon after a Monday market holiday when we just recorded a prior episode the Friday before. Literally, markets have not been open. So not that we talk about markets anyway. For those of you who are new to the show, you might be wondering, what do we talk about? This is the Pirates of Finance. In theory, we should be talking about markets, economics, capitalism, business ventures, investing, all that at large. We do from time to time. But we talk about a lot of other stuff too. Our feelings, emotions, what's going on in our lives, major tangents. What we definitely don't talk about is advice. We don't give you advice of any sort. Don't take this as advice. This is just two guys chopping it up. Who are we? I guess I forgot that part, Jason. It's been a while since we've done one of these, a whole 3 days, so I've forgotten my intro already. The handsome man sitting across the camera from me is the one and only young Hemingway, Jason Buck. I am his co-host, Corey Hofstein. Let's get started.
I'm going to be spending a lot more time in here with you lot because I love it in here. I fucking love it!
We were at the Global EQ Derivatives Conference in Vegas. It's an interesting conference of the audience, I think, is mostly banks, quantitative investment strategy folks from banks, some buy side, some insurance
companies,
pension, that sort of stuff. It's an interesting audience, not the usual audience I speak to. I guess there's two things I want to point out. So the first was when you and I were listening into some of the panels, what was weird to me is people sitting up on the panel were staring down. They weren't looking at the audience. And my interpretation was that is horrible crowd control. If you're on a panel, speak to the audience. What I learned, Jason, when it was time for me to sit on my panel, was two things. One, there were monitors down at the bottom that had cues. Two, the lights were so bright that if I was looking up into the audience, I could not see a single audience member. It was like staring into the sun. So I gained a whole new appreciation for why everyone on stage was looking straight down instead of out at the audience. More important than that, though, you got a tremendous number of comments on your hat that you wore around. And I don't understand why people in our industry continue to be so stuffy. They're like, I can't believe that guy would wear that hat at this conference. I'm like, why wouldn't you? I don't understand it. You're not insulting anyone. No one's offended by the hat. It's like free advertising. Everyone remembers the guy with the hat. And if you can add something interesting to it, you can follow up with anyone and be like, I was the guy with the hat. Versus you're just another cliche person in a dark suit and a blue shirt and a tie. I just sort of feel like clothing is an expression, as a way to stand out. And it doesn't have to be totally negative, right? You don't have to go crazy. You don't have to wear a clown outfit. But there's an opportunity to add a little spice to it and use it as a bit of a calling card.
Yeah, little zhuzh. I mean, you don't want to go totally that far away and just be just a complete lunatic. But by the way, I appreciate when those lights are so bright on stage so I can't see anybody in the audience. It makes my life a little bit easier so I can kind of space out a little bit better instead of having a panic attack. But you nailed it. It's as you know, it's the way I dress anyway. So it's not a put on, but it's when I look out, and quite literally there's hundreds of people there, and I look out across the room and all it is a sea of dark suits. And I'm like, this is so boring. And granted, you and I both know the invitation said business attire, I think, or something, business appropriate attire. And I'm like, this is my business. And secondly, I'm a grown man. You're not gonna tell me how to dress. And so, yeah, it's shocking how well that works. Even though I never really thought about it beforehand. And then now, like you said, it's afterwards, if I want to follow up with anybody, I'm like, I was that asshole in the hat. And they're like, I know exactly who you are. Yeah. And so that kind of thing works every time. But in fairness, we've kind of talked about this before at other conferences, Miami, etc. And I think it was Sean Jordan pointing out to me that perfectly, it was it's like Garanimals for adult males, right? if I wear blue suit pants, goes with blue suit jacket, goes with blue shirt, goes with black shoes. Like it's like Granimals for adults. And so I can understand why a lot of, especially if we're at a quant conference, like it's just easier than them having to say, hey, casual attire, wear what you want. They might just have a conniption trying to put together an outfit.
Yeah, that's fair. I mean, I think, you can say a classic suit is safe, and it is safe as long as it's well tailored. There are ways you can absolutely butcher it, but I think I don't know. I think it's a fun opportunity to just sort of express yourself and hopefully stand out it doesn't have to be positive or negative, but standing out a little. And then if you can add some value to it when you communicate with people, then they go, oh, it was the person who had a bit of a unique dress style. They really stood out. Their thinking stood out even more. I don't know why you wouldn't try to exploit that advantage wherever you can.
Right, and I most likely, as soon as I opened my mouth, I didn't stand out. I should have just kept my mouth shut like a good, like they used to tell David Beckham, no, just smile for the camera, don't speak. But it reminded me of, though, if you have, just to point out, like you were talking about, almost like single-use suits. But if you have a proper bespoke suit, and I think shout out to John Fio, I think he talks about this too. Is like it is literally like pajamas. Like if you have a really well-made suit with great fabrics and it's tailored to your body, it is like wearing PJs. So it's not stuffy at all. And I think people got used to kind of like shitty materials and off the rack, and they don't realize, like, when you have a really well-made suit, it is like akin to wearing pajamas, and it's buttery soft, and it's actually a very enjoyable experience. But going back to one of the things, like we some of the discussions that were had there, one I want to bring up, Zed Francis was talking about how he was talking about all the structured products that the banks are releasing, especially these worst stubs, which a lot of like single name equities. It's like funny how like Tesla, et cetera, gets in there. And Zed's conspiracy theory, or not quite conspiracy, was that the banks are doing that because they're putting out enormous loans to Elon and Tesla. So it's a way for them to hedge their risk when those if Tesla stock goes down and those worst stubs get knocked in from the structured product side, it's a way for them to hedge all of their loans to Elon and Tesla. I thought that was a really interesting conspiracy theory. I do
like that conspiracy. It would require a tremendous amount of coordination within the bank that I don't think actually happens. Right.
But
fair. I like it. You could assume, okay, who are all the major founder owners, right? Facebook, right. Microsoft, Tesla, and you go Amazon, and you go through that list and you go, great, just create a worst up basket, and it's a win-win for the bank, right? Selling that product, because if they are actually doing loans to those founders, you're right, that's great. So I don't know. It's a wonderful conspiracy theory. Who knows if it's true? But it's an interesting way to think through the logic of how do you offload bank risk from different parts of the bank via structured products. I mean, I would presume if the banks, well, for someone like Elon, it's like how much leverage is he getting from the banks? I sort of presume there's no way the banks could sell enough of those structured products to actually hedge their exposure. Versus someone like Bill Gates, I don't think he probably is super in debt to the banks.
Yeah, that's fair. One of the other ones that stood out, and I just want to pick out a few because Jeff Malik from The Derivative and I are going to do kind of like a podcast to overheard at EQD or what we thought was interesting. But one of the ones just from the very first thing about I think SocGen
Jeff right now.
Nah, pretty much. But I just thought it'd be interesting. I'll get your take on this. Is SocGen did a presentation on climate change, global warming, et cetera, but more the transition to EV vehicles and rare earth. And it was interesting that he was pointing out that transition to rare earth minerals, metals, etc., is that most of those are spots markets and they don't have futures markets. So there's not really a way to bet on those. And I thought that was a really fascinating look at that approach. Is everybody wants to kind of bet on those outcomes, but you can't get access to those except for the spot markets. And then related to that is he was showing on his charts how geopolitically, it causes a lot of issues because most of them are from sub-Saharan Africa and or China. But my pushback would have been that's where the rare earths get refined. We still have plenty of rare earths in the United States. It's just we don't have the wherewithal to clean and refine them. We're not willing to do so for the cascade of consequences from having to refine those rare earth metals. But I was just curious, if you had any input on either of those.
Yeah, I think it was an interesting example of you can have a thesis that is, I don't want to say uninvestable, but not easily investable, right? So what's the dirty basis trade? Do you try to buy the equity in the companies that have meaningful exposure to that? Well, are they even publicly traded? And then 2, can you actually invest in them given where they're located? What exchanges are they on? And then 3, right? You're getting a proxy exposure because you're going to be entirely driven by the performance of the company. They can mine the hell out of these rare earth metals and still drive themselves out of business, right? By running a terrible operation. So there's a huge basis risk there. It is interesting to think about. Something I've never really considered is, at what point does the spot market get large enough that it justifies someone launching a futures market, right? Where does that demand organically bubble up from? Or when does CME or whomever say, you want to know what, now's the time, we need to do this. LME, whoever it is, like, we need this futures market to exist. And they're either going to try to breathe life into it, or there's enough, demand from the suppliers or the demand side that they want that futures market to exist.
Yeah, it's surprising that like the CME didn't take over a lot of the LME instruments, but I think they pointed out before, it was like there's not that much liquidity or trading there, so that's why they maybe haven't taken over. I'm sure. Have you ever looked at like the Chinese markets where you have like rebar and palm oil and like even like styrofoam and a lot of things we don't have? So
apples,
like, so it would just, maybe once those got to adequate size, I think that's when the CME starts sniffing around and maybe wants to release some of those contracts. But
I'm not sure. Well, I'm totally talking out of school here, so I'd love if someone could correct us. But with some stuff like Chinese Apple futures, I'm not sure the CME could list that stuff. Like, I'm trying to think through the actual.
Not saying the Chinese ones, like just global Apple futures where like it's a proof of concept with the Chinese markets. But
as
then we have
an Apple
rebar.
connoisseur, though, as an Apple connoisseur, they're non-fungible. Apple is not an apple, right? Don't give me your shitty, I don't know, Macintosh when I want Galas or Honeycrisps.
By the way, do you know like how that all works? Is basically you patent an apple or a hybrid of an apple, but you could patent the name. So that's why we get these pink ladies, these Galas, these Honeycrisps. They're defending the naming rights because you can trademark the name and then you can promote and market the shit out of that name. And this is why we're able to kind of list off all these Apple varietals, is because they created these names as marketing ploy and trademarking effects.
I got a funny little trademark story for you.
Please.
We're going on a real tangent here. So I recently was granted an official trademark. So not the TM, but the R on a phrase my business uses. But we went for two phrases. One was sort of a past participle form of the word, and one was a gerund form of the word, if you will. And we were granted one and not the other. And the U.S. Patent Office said, well, you can't have this other form of the word because it's become too pervasive in the industry as a generic term, which I thought was sort of funny because it just meant that we have done such a good job marketing the phrase that it's become too widespread for us to own it anymore. So kudos to us, I suppose. But their evidence that they provided in their letter back to us was a list of 10 websites that use the phrase. 9 of the 10 were in reference to me or the paper I wrote about the phrase. And I'm sitting there, I'm like, if you had spent 3 seconds, like one of the articles they sent literally said, this new phrase, which has been added to the investment lexicon by Corey Hofstein and Rodrigo Gordillo. And I was like, it literally says we came up with the phrase, and they're using that as an example of it's now too broad a phrase to be patented. So not patented, registered as an official trademark. So I'm now in a fight with the US PTO, and hopefully I'll win.
Hopefully you'll win as being the founder of the circular nature of it. By the way, it reminded me of I want to say it was on Meb's podcast, but I'm not so certain. But like he even said, how are you structuring this? Is it basically like return stacked? So like now you're like, it's becoming part of the lexicon. Like that's amazing. I remember hearing that. I was like so excited for you that like people are using it to describe things. I've had people say it back to me even on sales calls. It's like, is this like return stacking like different asset classes?
So it's
like,
funny. Wow. I mean, there's this weird thing when you register a brand, right? Then it is actually, we have to go defend it. And the question is what do you mean when you defend it? Like you and I can talk about Nike, right? And Nike's not going to come and say, let's like slap us on the wrist. What you really need to protect against is infringement, that we would create shoes that say Nike on them, right? Try to mislead people into thinking that a good or service is related to the brand trademark when it's not. And so for us, right, this idea, you mentioned it's return stacked and return stacking. Those are important brand trademarks for us. We're getting to the point where we're fine with the end consumer talking about things being return stacked, or is it a return stacking concept? But we no longer want peers or competitors to describe their own process that way, because we think it's an important brand asset for us that we've introduced. So we'll see how it goes.
I was seeing you and Rodrigo become patent trolls for return stacking, trademark trolls, and that's how you make a living, is just the cease and desist and suing people over time. But I you and I have talked about, it's like I can't stand even when people talked about like what we do similar to like all weather, and I'm like, I'm not going to be defined as somebody else, but I see why other people do that, because shorthand, we all need shorthands in life. So it makes it tough. And like you said, a good trademarking is not going to really help you, because then how much you're going to spend, on cease and desist letters from lawyers and all that stuff. It's like, that's not how you want to spend your life.
Yeah, I really just wanted it so we could slap it on fun names and all that sort of stuff. And it is valuable to have for us, because I do think it's a valuable brand property. But I laugh. I literally, right before recording this, I got off a call with an advisor who was talking to me about the portfolio, and he was talking about some funds he owned. He goes, "Oh yeah, I bought these 2 return stacked funds. I learned about them through you. Are they my funds? No, they're competitor funds."
Yeah.
And he's like, "I love this concept." I was like, "Great, maybe you should have bought my funds."
Well, I think the original paper had a bunch of funds in it, but they were anonymized, right? Like that was all right. So I got a couple other subjects for us. One, I was reading Jared Dillion's Daily Dirt Nap this morning, and he was talking about Nvda and how much it took off. And but he was saying he was getting a lot of comments about people buying, or maybe you've seen it on Twitter, about people buying puts on Nvda. Like, man, does that scare the shit out of me? Like, man, talk about a perfect example of a market could stay irrational longer than you could stay solvent, because everybody's talking about, price to sales or the multiple and everything like that. It's just like, good luck if you're buying puts on Nvidia.
Yeah, well, 2 things. There's the short delta, right? So are you trying to do a levered short versus that's not really what a put expresses, right? You're repricing on the put. Yeah, you can have the delta, but it's really about the implied vol.
Right.
And it's like you could be buying a put at such a high implied vol that the price does fall, but implied vol falls just as fast, and you lose money. Right. So it's like, I think people can get really hurt when they think about buying puts and calls if they're not careful about what they're actually trying to express. And with the puts and calls, it is a huge amount of vega. They need to be aware that there's an implied vol bet. And if they don't have a view as to whether implied vol is going up or down, they should. Right. That's what's getting bet on there.
And then vice versa, just quickly, vice versa too. That can happen in other ways. If you're buying at a very low implied vol, like I know people that made money off of S&P calls in Q1 of 2020 because like implied vol expanded so much. So it is really, it's not a delta play, it's a vega play, or it's a both. But you have to know what you're buying and what price you're paying. So sorry, go ahead.
Yeah, I think the general point is like if you could frictionlessly delta hedge the option value changes because of the implied vol, right? It's not a delta play. So, but again, to your point, like people go, "Oh, price went up, time to short." Like that's a dangerous game to play. That price can keep escaping, particularly because people are trying to short because they're going to get blown out of their shorts, right? And they're going to have to buy back, which is going to drive the price higher. There's all sorts of things that can get absolutely crazy in the short term, and I think people have to be very careful about how they're expressing this stuff, right? You could, for example, and again, you got to be careful about where you're buying the implied vols here, but I think if you're going to be shorting this stuff, I think you should consider how you can buy a call as a tail hedge to your short, right? Like those are the sorts of trades you might consider, again, being very thoughtful about where implied vols are priced, because price could keep going up. But I think the argument is like, if price keeps going up in a crazy way, implied vols are probably continuing to expand. So you're probably not going to get as hurt hedging that side. But this is a dangerous game to play, as we saw in the meme stock era.
I mean, before the meme stock era, like, and you know how many times I thought it was the perfect time to be buying Tesla puts throughout all those years as it ran out from like 100 into the 1,000 rate. Like, it was just like every time you thought like, well, this is finally the fraud's coming out, you know, and like, you know, the alleged fraud was coming out, and like, you're like, here we go. Never worked. And I think Mark Cahote says like a great quote about this is like, he's like, I'm too old to try to climb up in a tree and wrestle a jaguar out of a tree, get it on the ground and try to kill it. He's like, I wait till it's like on the ground, dead, dying, and like I'm just like a vulture that or a hyena that just comes and picks apart its carcass.
Yeah,
That's just the way you have to play it.
I think that's right. There's a very asymmetric bet to shorting, and you're particularly with stuff like this that can be very flow driven in the short term. It's a very dangerous game to play, and I'm not sure there's a huge amount of like extra value in getting the exact top.
The other one I would bring up with you that I was thinking about over the weekend is like there seems to be or I'm just hearing myself in my own echo chamber, a lot of movement for like credit funds, etc. And people that want to especially lend to, you know, medium-sized American businesses. And they keep talking about the yields, you know, they're getting anywhere from 12 to 18% yields. But the interesting thing for me, and this is related to when I was in commercial real estate, is I wonder, do you think people think about like, oh, did they just go for the yields, or do they ever think about the higher the yield I get from this medium-sized business, the more likely are they to default? Like, and I'm not sure people think about that. They just want to squeeze as much yield as they can, but not realize the hurdle rate on that yield is likely going to bankrupt more of those businesses than they prefer because of the higher yield. So, for example, like the way I say there's analogous to commercial real estate for me is like every landlord wants to get the highest rent possible for like their commercial lease space on Main Street, but by constantly increasing that, you're increasing the likelihood that retail store is going to go out of business, and then therefore you're going to be tenant less for like months at a time, and that's going to affect your overall return. But I just feel like people don't think that way.
Yeah, I think you're spot on. There's a balance between, right, to your example about commercial real estate, profit versus occupancy, right? And if you drive or immediate revenue versus occupancy, and you need to hit that perfect sweet spot of you're maintaining maximum occupancy and charging the maximum price at the same time, right? And they're not. Those are two levers that you have to be considerate of. I think you're spot on. If you could say, I'm going to get a 20% yield on this bond that I'm giving to a company, and in doing so, or the company's going to issue a bond, and it's a 20% yield. You know, that 20% yield is going to drive them out of business, versus I could get a 10% yield that they could be safe.
Right.
But oh no, I like if it's unsafe, I need the margin of safety. I need them to pay me more up front. I think it's a tough game. To your point, there is a circular aspect to it, right? Higher yield obviously means higher risk, but that becomes self-fulfilling because they can't continue to pay the debt, and so it drives them out of business. They can't raise a new round of debt to pay for the old debt, and so yeah, I think there's an interesting sweet spot. I'm not sure that is up to. I'm not sure that's the buyer, though. I think that is like the bond issuer is the one who should be thinking about that more and saying, like, what does the market need? What's my risk level, and what is the minimum yield I can offer to try to raise the capital I need? And what does that do to the security of my business, right? It's up to the operators to know what sort of debt they can service.
Yeah, I want to say junk right now is averaging like 12.5% on like kind of floating rate. But like, I'll flip it around, like to the point you were just making. To me, it was always similar to cap rates in commercial real estate. It's always a delta over like the risk-free rate, right? So if the risk-free rate's gone off 500 bips in 2020, let's call it, I'm sorry, 2022, about 500 bips, then you expect that delta to go up by 500 bips, right? And then it's about the company or the borrower or whoever like thinks they can exceed that hurdle rate given the market environment. So like it always is a reference to like the risk-free rate and a certain amount of bips for risk over the risk-free rate. Is that like the fair way of thinking about it?
Yeah, I mean, I think generally speaking, people are very drawn to the magnet of the nominal return, and they don't think about the excess return. That's something you and I talked about ad nauseum.
Yeah.
Well, last week and in Vegas, right? I think we should always be framing in the excess return. I think the excess return implicitly in many ways captures a real return, because I think cash rates, at least in the US, are a decent proxy-ish over the long run for inflation. They tend to at least keep the value of your dollar. But, again, people just see the high numbers and they get attracted by the high numbers. Most people aren't thinking about what cash returns are necessarily. But know what this sort of conversation about debt makes me think of is the PPP loans, but another sort of PPP, Jason, the Pirate Pinky Promise. I think the Pirate Pinky Promise, the Pirate Pension Plan, the Pirate, I don't know, so many ways in which the PPP could be discussed. But it's important to us, right, that people fulfill that sort of side of the obligation. If this is debt, Jason and I are hoping you fulfill your side of the obligation, which is to hit subscribe, turn on that bell to know if and when we go live, share with your friends, leave a comment, rate, review. All that helps us grow this channel. Again, we do this for fun, our own enjoyment. This is what allows me and Jason to actually connect once a week and just riff. But it ain't free. It ain't free, folks. So please do your part. And that's all I got. Jason, anything you want to say before we head out?
Yeah, quick one. Speaking of fun on the side hustles, is like you and I like to hate watch a lot of stuff on YouTube. And one of the ones you always see. Yeah, one of the ones we always see is the side hustle, right? Everybody's got to have a side hustle these days. But I always think about side hustle. They always go, your average millionaire has like 6 streams of income. You got to start a side hustle. And everybody go, oh, how many streams of income does your average billionaire have? Oh, yeah, 1. And so like how much of a side hustle is a distraction that keeps you from doing the thing that would hopefully get you to achieve your goals, assuming you have those, the goals or whatever you have, or how much is like that, or does side hustle potentially your Tarzan swing to get to that next thing that you're passionate about? I think this is a tough one that nobody really takes into consideration.
Well, I like to say I have hundreds of income streams.
Nice.
Largely because I own a large number of individual stocks that pay me dividends. And those are all my income streams. Just hundreds and hundreds of them, Jason.
I was going to say, well, you have hundreds of clients too, right? And those are your individual properties.
Yeah, that's a good point.
Speaking of monetizing this podcast, that's our monetization heuristic. Like, you just have to subscribe to this podcast. We're out here, Corey's driving through the night trying to make it to the show. We need to afford some, paint for his walls because they're hideous. These are the things we're working on to improve the show. But all we ask from you, our Pirate Pinky Promise, is for you to subscribe to the show.